Hello, welcome to Mondays on Main with me and Adam Delmonico. Adam, we're gonna just jump right into everybody's favorite thing to complain about right now.
Yeah.
Rates.
Yes.
Tell us what is happening with the rates right now.
Yeah, so, I mean, if you think back to even pre-2020, pre-COVID, as soon as COVID hit, that was the talk of the town. That was in every news headline was interest rates. And fortunately for those 2-3 years, it was all positive, right? Rates were going down, which was bad for the economy just because everything going on with COVID. But, at least you got lower interest rates. Since then, since COVID has slowed down and, a lot has transpired in the economy and the political landscape, rates have increased, pretty substantially since then. But it was really nice because buyers got into a flow. So rates jumped up to about 6%, 6.5% in that range, and they stayed there for 6-7 months almost, right? Mm-hmm. That's been the range that we've been in. So buyers, they had an initial shock 6 months ago, but since then they've, the ones that are still shopping have gotten over it. They're comfortable with their approval amount. They're comfortable with their projected monthly payment. And we really haven't seen much deviation from that range, in months. Unfortunately, due to this debt ceiling crisis that's looming, I'm sure everybody has heard by now about the debt ceiling. It's an issue. But every single time that this has come up in the past, the politicians have figured it out. They've increased the debt ceiling, they've come to an agreement, they've never defaulted on debt. And right now, the fear is that if the government defaults on their debt, that's going to send interest rates to the moon because what would happen is investors would not have any confidence in the U.S. economy, wouldn't have any confidence in the bond market, and so they would take their money out of the bond market. They take their money out of the bond market, that's what drives interest rates up, is when people pull liquidity from the bond market. So what we've seen in the last 2.5 weeks is investors getting defensive and pricing in the fact that this may happen, even though it's never happened in the history of the U.S. economy. And it's caused interest rates to break out from their range and unfortunately have gone up a decent chunk in the last 2.5 weeks. So right now for the average 30-year fixed mortgage, we're over 7%, which isn't the first time we've been here. But it's definitely going to put some strain on buyers.
Is that even for an A+ buyer?
Yeah, so with no points on a 30-year fix, the best case scenario is probably 6.8, 6.9, so barely hanging on. But unless you're putting down a large down payment, like 30% plus, you're going to be over 7%. Now you can pay points and buy the rate down into the sixes. It's always an option that we talk about. But if you do no points and you're just doing 5% down and you have an average credit score, let's say 700 or 720, which is still a great credit score, it's just, there's higher credit scores out there, you're going to be over 7%. And it's not something necessarily to be worried about. It's not a fire drill. It's just if you were shopping, you need to talk to your loan officer to figure out how does this impact you.
So just going back to the debt ceiling situation, I know you don't have a crystal ball, but is there an anticipated timeline for when they might sort that out? Let's say I'm a really conservative buyer and I want to just hear that we're good and then I want to move on with my purchase. Do you know?
Yeah, sometime within the first 2 weeks of June. Sometime within the first. So it's going to be fairly, soon. So it's not going to be a long drawn out issue. It's just, first 2 weeks of June. And the expectation is that, every other time that this has happened, they've raised the debt ceiling and, everything has been fine. But they have yet to do that, which is not abnormal. But within the first 2 weeks of June, we should have an answer and a resolution.
So let's say that you have a bunch of buyers right now that kind of just got priced out of being able to purchase a decent home with a good budget because of this jump, right? What's your strategy to tell them so that way they will be in a position to buy sooner? I'm sure it's not wait till the rates go down.
Right. No,
because
absolutely.
I've had a lot of people tell me that they're going to pause their search and wait until the rates go down, but do they know when that's going to be? Because I don't.
I know that no crystal
do they know something we don't know?
And the tough part is prices are going to continue to increase. Even with this rate jump and even knocking some buyers out of the market, the supply and demand, is still super out of whack. So prices are still going to go up. So even when rates come down, prices will be higher, but that's a different conversation. So the strategy that we would have is a couple of things. Make sure your credit's as good as it could possibly be. There's a couple small credit cards that you can knock out that's going to only cost you a couple $1,000 or something, and that could boost your score. We're going to take that route, right? Where before maybe it didn't matter because you were still comfortable, in the low sixes for a rate, but now having really good credit matters more than ever. So that's the first thing we would do. Continue to save. It would be the second thing that we would have people do. And then the third is maybe put a little bit less down and use the extra funds to buy down your interest rate. Putting $5,000 more towards a down payment only impacts your monthly by about $30 a month. But if you take that same $5,000 and let's say a $400,000 house, right, and you use that to buy down your interest rate, it's going to be like $75 to $100 a month that it'll save you, right? Okay. So put a little bit less down, which will cause $30 increase in your mortgage payment, but use those funds to buy down the rate, saves you $100, so you're net $70. In the green. Yeah, in the green. So you're in a good spot. The reality is rates ebb and flow. Anyone purchasing right now is going to be refinancing, most likely in the next 12 to 24 months. So it's a little short-term pain, but if you're a buyer that can still comfortably get into a house, this is going to be your opportunity too, because there's going to be less competition. So I think it could be a good thing.
Why do you say that they would refi within 12 to 24 months? Are you saying that because you think that they're going to have more equity in their home, and then because you don't have to refi to get the PMI taken off, right?
No, so the reason that I would think that they would refi is we're just at the top of a cycle, right? Mm-hmm. We're at the top of an interest rate cycle. If you look over history, they go up, they go down, just like the stock market. So the expectation, and there's no guarantee, and I would never have somebody buy a house if they were only comfortable with the expectation of refinancing, right? Because you may never have the opportunity to refinance. This may be the new norm. Who actually knows? But the overwhelming majority think that in the next 12 to 24 months, as inflation continues to come down, as this debt ceiling works itself out, also in an election year, super not political, but in election years, if you look back historically, interest rates do really well during those time frames. Everything is working towards lower rates. We probably won't see 3% again, maybe even 4%, but low mid fives is going to open up the door for so many people to refinance, especially if you buy at 7% today.
And in your professional opinion, you still feel that it's worthwhile for somebody to buy a home with the rates as they are today?
100%, just because the alternative, right? Rent is insane right now, and that's the reason that the market is still so hot with increased rates. Is like, what are you going to do, right? If you go rent right now, what would you say in Providence, or in Rhode Island, in a good area, a good school district, a 3-bedroom house would rent for? What would you think? What would you say? Like,
in a good school district, probably like $3,000 to $4,000 a month.
Yeah, that's like insane.
Yeah.
Right?
And we just listed a new apartment rental, a 2-bedroom in Johnston for like $1,850, and it was for a 2-bed, and it was rented it was on for like 24 hours.
Crazy.
And my phone's still ringing over it.
Yeah. So that's the reason that I believe that it's still important for people to buy, and why it's still a good time to buy. Now, if you're living at home, or you're renting from a family member, maybe it's not your time, right? But the overwhelming majority of buyers, they're buying because they have to. They're not in a situation where they can do anything else. Maybe their landlord's selling their property, and the reality is if prices continue to increase, which there's almost impossible for them not to because of the supply and demand, a difference right now. You can always refi down the line, but you can never go back in time and purchase when prices were lower. So
I sold a house. And it sold for $470, and then he hasn't done anything to the house besides replace the roof on the garage.
When was this? When
2021.
2021.
He bought that house for $470. He just had it appraised $525.
Crazy.
$550. He wanted more money because he did a HELOC, so he got $550 out of it, and that was the value of the house.
That's insane.
And he hasn't really done anything to it, and I think
$7,000 over 2 years.
Right.
It's not doing anything.
And I think people that, that have the luxury of being able to stay with family and save money and take their time, good for you, that is a smart move. But at the same time, people that do have to buy, it's still a good time because you're paying somebody else's asset when you're a renter. You're paying somebody else's mortgage. That money is just literally going to nothing. So, I mean, I understand that people have their reasons for renting, like temporarily and things like that, but if you really put it into perspective, like having that asset, once you have a house, then you can take your equity from that house and, you know, buy another house or do a project on your house to make it more beautiful or whatever you want to do. So it just gives you like one step closer to financial freedom and leverage and, you know, the American dream.
Right. And I was working with a slew of buyers in 2020 when the market started getting hot, and they were like, I'm going to wait because we're at the top of a market, right? In 2020, right?
Oh, yeah.
And if you look at the average home price in 2020 in Rhode Island, it was probably $320,000.
Yeah.
And now like low threes, and now we're at like kissing 500,000, right?
Yeah.
And they thought it was the top of the market in 2020. Probably thought it was the top of the market in 2021. The reality is the only way for prices to come down in any industry, in any market, is for there to be more supply than demand, right? There are more
over
homes for sale.
Over 6 months worth of supply would make it a buyer's market in Rhode Island, and right now we're only at 1 month.
1 month inventory.
Yeah,
crazy.
And even sometimes it's less than that.
Houses we would need to have 6 times as much inventory right now for it to be an even market, not even like a buyer's market, like an even, you know, seller buyer market. So you know, that's just the reality is that prices very unlikely that they do anything except going up. So get into a house now. You know, if you're comfortable with the payment, even if it's a little bit more than you want to, and then, you know, refi down the line when the opportunity presents itself.
Yeah. Okay. Well, thank you, Adam. That was a lot of really valuable information, and stay tuned for our next episode next week.
Thanks.